Good afternoon and welcome to MF Corner. I'm Sumera Abdi, and today on MF Corner we have two very interesting topics for you. First, we're going to talk about arbitrage funds. There's been a fair amount of chatter on how spreads have turned negative. What does that mean? Should you still invest in an arbitrage fund? All of that is lined up with Ashish Shanker, who's the head at Motilal Oswal Private Wealth Management. Also, a little later on the show, we're going to talk about whether you should be rebalancing your portfolio given the pandemic and the way it's unfolding. So how to actually allocate for future uncertainties. That is lined up with Anubhav Srivastav of Infinity Alternatives in a bit. But first, let's talk about arbitrage funds. So arbitrage funds have actually seen, or rather you can say the average arbitrage spreads have turned negative. We saw that in March and we saw that again in May. What does this mean? So spread is actually the difference in the buying price of a stock between the cash market and the futures, and this is what the arbitrage funds do. They buy in cash, sell in future, and the difference is the money that they make. Now this difference turned negative. So what does that mean for the arbitrage fund that you're holding? What does it mean if you're looking to invest in an arbitrage fund? First, let me go across to Ashish Shanker. Hi Ashish, good afternoon and thanks very much for joining in. So first things first, tell our viewers what exactly is arbitrage, how does it work, and what does it mean when someone says that the spread has become negative?
Right. So Sumera, simply put, arbitrage is the accrual that you lock in when you buy the share in the spot market and you sell the futures. So to give you an example, let's say a share of any company, if it's trading at 100 rupees in the spot market, normally the futures trade at a higher price. So let's say 101 rupee. So you buy the stock at 100 and you sell the future at 101 rupee. Now the expiry of the futures market happened at the end of the month. So at the end of the month, the spot and the future price do converge, and when you settle, that 1 rupee is what you make as an arbitrator, and that's what arbitrage funds try to capture. Now, like you said, it could vary, the spreads could vary month to month depending on the market and depending on many other factors that we can talk about.
Okay, so when you say that the prices converge, what happened in March and May? Why was there a negative spread? And April conversely didn't have that negative spread. So what are the factors that drive it, and what is important for an investor of an arbitrage fund to track?
Right. So whilst, like I explained, arbitrage fund tries to capture the spread between the spot and the future markets, there are a lot of factors that one must be knowledgeable about before investing in an arbitrage fund. So typically what happens is the spread will widen depending on what is the view of different participants in the market. So typically what happens is when you're selling the future, there is somebody else on the other side trying to buy the future. Now he's buying the future because he is bullish on the market and wants to carry a leverage position in the market. So typically when markets are bullish and a lot of participants want to buy more equities through the futures market, the spreads tend to increase. Now, there are certain months where market becomes very bearish, which means there are more sellers than buyers in the equity market. So a lot of people tend to go bearish on the market through the futures by shorting the market. So at that point in time, there are peculiar months like we saw in March where the futures price can go below the spot price. Now, in case of an arbitrage fund, what happens is that they have the flexibility that when there is no spread available in the between the spot and the futures market, they can keep the money in liquid. But what happens is when there is no opportunity and they keep the money in liquid, it brings the return of the fund down, and that's exactly what we witnessed in March. So this is one of the nuances that one should be aware of. The second nuance, Sumera, is that what happens practically at the end of the month, once you settle the position of the previous month, you also make future positions for the next month. So what you do in effect is a rollover. Sometimes on that particular day when you roll over, the spreads could also widen between the spots and the futures. So in effect, there could be a mark-to-market impact on a month-to-month basis. So these are nuances that the investors should be aware of before they come to the arbitrage fund category, and hence the minimum time horizon should be 6 months for anybody wanting to invest here.
Okay, so Ashish, if you're recommending that the minimum investment horizon is at least 6 months, does it matter, if the returns or rather the arbitrage spread over 2 months is negative? I mean, would that really diminish the overall returns?
No, so like I said, Sumera, you could have a month or two where some of these nuances play out against you, and hence the return in a particular month could be very low, or we have seen very rare months where the month-to-month return has also been negative. But generally, over a 6-month period, it tends to even out, and you get a return which is slightly above money market or slightly above the 6-month interest rates that are prevailing at that point in time.
Okay, Ashish, this has also many times been referred to as quite tax efficient. Is that really so?
Yes. So what happens, Sumera, is for anybody investing in any debt product, whether it's an ultra short-term fund, liquid fund, or let's say a low duration product, the gains are taxed at the marginal rate. So depending on whether you're a company or an HNI, you will pay whatever is your marginal rate of tax. As opposed to that, the arbitrage fund in the tax classification is an equity fund. So what happens is, in an arbitrage fund, even if you sell before a year, you pay short-term capital gains, which is generally lower for most HNIs or corporates as compared to their marginal tax rate. So give you an example, 15% plus surcharge was what will apply for short-term capital gains, and long-term for arbitrage funds is more than 1 year. So as a result, a lot of the money that HNIs or corporates or investors have for periods between 6 months to 2 to 3 years, because this is what I call uncertain debt money, which you may need at any point in time, can be parked in this category of funds, because it's more tax efficient. Your post tax returns are much higher.
Okay, fair enough. So therefore, is it just an instrument that an investor must use when he needs to, sort of have access to money, which does not necessarily figure in his overall, long-term wealth management strategy? Or should an arbitrage fund actually be an active part of somebody's core portfolio?
So, look, if someone is very clear about the time horizon and let's say the fixed income part of the portfolio, which is for greater than 3 years, and you're confident that you may not need that money, then there are different fixed income funds that is preferable, because after 3 years, the fixed income funds also enjoy long-term capital gains and you get the indexation benefit. But however, what we have witnessed, Sumera, is that a lot of people are not very clear or certain about the time horizon for the entirety of the portfolio, because there are needs which come up after 6 months, 12 months. Somebody is trying to buy a house, but they think that it will take a year for them to make that purchase, and hence they want to park money. So that uncertain part of the portfolio, because remember, a lot of people also keep money in liquid, and sometimes that liquid money remains for 6 months, 12 months, 18 months. So that part of the portfolio can definitely be in arbitrage. The other reason, Sumera, right now a lot of us are recommending arbitrage funds is because you are at the probably lower end of the interest rate cycle. RBI has cut rates very, very aggressively, and one can argue that at some point, maybe a year or somewhere down the line, when there is a economic recovery, rates may move up and debt funds may as a result suffer. So arbitrage fund also is interest rate neutral product. So it serves as a parking vehicle for people who are not very clear about the way interest rates will move in the near future.
Okay, Ashish, if somebody was to try and shortlist an arbitrage fund, what would be the driving factor? Is it the skill of the fund manager? Because naturally, this has this whole role that the derivative market plays in it. Should you also look at the size of the fund itself? I mean, does it become unwieldy as the fund grows in size? What are the 3 or 4 parameters to sort of monitor when you're narrowing down on a fund?
Right. So first is, you're right, you have to figure out what are the capabilities of the fund house. Generally, I have seen most large institutions who have decent systems and infrastructure would be good at arbitrage, because arbitrage funds are primarily first about execution, whether you can execute trades efficiently. And now, because of the advent of software, most larger institutions would have the capability to do this kind of a strategy. Second, I think what is also important is the fund house has to have some understanding of equities as an asset class, because at the end of the day, we should not forget that you are trying to make money off the equity markets, although you're basically trying to make the spread between the spot and the future, and in that sense is market neutral, but you're trying to make a spread of the equity markets. So some capability in equities helps. In terms of size, this market gets liquidity predominantly. I mean, there are multiple participants. There are FIIs, there are domestic mutual funds, and there are proprietary investors who try to arbitrage in this market. But a large part of the liquidity comes through the FII segment. So in a very buoyant market or in a normal market where FII investments are coming in regularly, liquidity doesn't become a challenge. But generally, I would argue that today the category is about 62,000 crores. In March, it was close to 85,000 crores. I think at these sizes, it's fine. But a size is definitely a consideration, and if the fund size becomes too large, then one should prefer a medium or a smaller size funds as opposed to a much larger fund. Now, I don't have a hang on the exact number whether 15,000 crores is too large or 20,000 crores is too large, but generally when a fund house becomes, let's say, 25-30% of the category, one must start becoming a little sanguine or wary. But as long as the fund house is maybe 10% of the overall category, I think things should be fine. Right now, size is not a problem, but one should be monitoring this closely. That's why an advisor is very important when you're trying to make these decisions.
Okay, and because we're talking about arbitrage funds, I don't want to leave out an NFO that's coming up on the 3rd of June. So Mirae is also venturing into this category. Would you, what would you recommend on the NFO? Could people look at subscribing to it? And what would be the pros and cons?
So again, like I said, Mirae is starting off on a clean slate, so size will definitely not be a problem. So that's good in an arbitrage fund because you are more nimble-footed to lock in opportunities. Second, Mirae generally has been very good in equity as an asset class. They've generated pretty good returns over a longer period of time. So equities as an asset class is something that they understand extremely well. So I would definitely look to invest in Mirae Arbitrage from the arbitrage part of my portfolio. And also remember one thing, Sumera, all these views have to be looked at from an asset allocation point of view. One thing that this crisis has taught us is that we should be diversifying our portfolio. So again, from your fixed income portfolio, invest only that much that you believe is uncertain money, maybe 10, 20, 30% in arbitrage funds. So that is very important to understand before you make a decision.
Yeah, absolutely. Ashish, I take your point entirely. Is that don't look at funds which are discussed as a bland recommendation. Do see how a particular fund would fit in individual portfolios. And on the other side, we're going to talk about exactly that. So Ashish, thanks very much for joining in today. But we'll take forward this discussion, and when we return on the other side of the break, we'll talk about how a portfolio needs to be realigned, especially in the face of a pandemic. Anubhav Shrivastava of Infinity Alternatives will be with us next.